Hi, I'm Dr. Bill Conerly, and I'm joined today by Dr. Tim Dewey, one of the country's most well-respected Fed watchers, observers of Federal Reserve policy. The Federal Reserve is doing some different things, and we're going to talk about what's different, keeping this in a business perspective. So I'm going to be asking Tim, what's different about what the Federal Reserve is doing? What does this mean for the shape of the economic recovery, if we're going to have one? And how can businesses take advantage of the new programs? Tim, thanks for joining us.
Oh, my pleasure. Thanks for having me, Bill.
I'm going to begin by sharing a screen that shows, here we go, a little bit about what the Fed has been doing. The Federal Reserve had a meeting late January, no change in policy. And then March 3rd, they cut interest rates by 0.5%. 0.5% is a larger than usual move, but not at all unprecedented. 2 weeks later, they cut interest rates by a full percentage point and added a great deal of quantitative easing. They did a couple of foreign exchange liquidity programs, and then a big decision at the end of March to fund corporate bonds, business, and consumer loans. And this is a very, to me, a confusing set of pictures. Can you, Tim, give us a perspective on sort of what's been going on, big picture, before we get into the weeds?
Okay, so the very big picture is the Federal Reserve has two goals, right? One is an immediate goal of preventing the financial system from collapsing. Right?
Yeah.
So this is the mistake that we think was made during the Great Depression, that we sort of let the economy just slide away from us, and that turned out poorly, shall we say. And so the Fed wants to prevent that mistake. The Fed also wants to set the stage for the eventual recovery. And that's not only keeping the credit markets intact, but creating accommodative financial conditions so that, when people are able to or are willing to borrow money and expand activity, that they're able to easily do so at low interest rates. So we've got those two objectives, both the support the economy now, keep the financial sector together, create the conditions for a more robust rebound when that rebound happens. And I believe it will happen. I just can't tell you exactly when it will happen.
Okay, well, if you don't give us a date, we can't hold you to it, I guess.
June 1st. No, I don't know.
Which year?
Yeah.
So the Federal Reserve has added a bunch of tools. It seems to me added a bunch of tools. Their statement was that they are willing to use its full range of tools to support the U.S. economy. And before we get into those tools in detail, I've been in the Federal Reserve boardroom. I didn't actually look at their workbench where they have the tools hanging on the wall like you have in your woodworking shop. But I don't recall seeing these tools on the Federal Reserve workbench before. Were they always there and nobody noticed them, or are they creating brand new tools?
So a lot of these tools were started to be developed in the last crisis. So, for example, the lending facilities that the Federal Reserve is bringing out now were based on work that really was done in 2007, 2009. So one of the interesting points here is the Fed has rapidly brought out a bunch of programs, tools, and the like that were created. I mean, they basically did in 2 weeks what took Ben Bernanke like years to develop, create, and fight for. And since the Great Recession, I know I'm going to try to keep these all in my mind, right? The Great Recession, the Great Depression. Since the Great Recession, we've spent a lot of time researching what would happen when we get to the zero bound again. What tools were effective?
The zero bound is
the lower zero bound for interest rates. So basically, once we brought interest rates to zero, we use up some of the traditional monetary policy tools. We have to think about the less traditional monetary policy tools, although maybe they'll become more traditional in the future.
Right.
And so we had started working on a lot of these ideas on how we manage activity, and really because of that experience, the last recession, and the research since then, the Federal Reserve was able to move very quickly on just an enormous scale in just a matter of weeks. And I think this will really prove to our benefit in 2 or 3 months, now that we're going to see that the financial system most likely does not collapse.
Okay, well, I want to get to the impact of these, but let me share the screen again. And are you seeing, Tim, a slide with a bunch of tools on it?
It has not come up yet. Oh,
okay, there we go.
There we go. Right. So, new financing for employers, consumers, and businesses, support for large employer bonds, asset-backed securities, term asset facility, money market, commercial lending, and then Main Street business lending program. And then also we could include the support for the personal, the paycheck protection program. Right. And that's also another avenue by which the Federal Reserve is trying to support the economy. The way I kind of summarize many of these is in 2 fashions. One is to promote market functioning. So to the extent that, for example, the Fed needed to buy support treasuries because there was suddenly investors were trying to get cash. They were selling a lot of treasury securities. Some treasury securities are actually less liquid, believe it or not, than other treasury securities. Treasury securities that are on the run or recently issued by the Treasury Department are more liquid than off-the-run securities. So the Fed had to actually expand quantitative easing to help support that. So that would be kind of a market functioning aspect. And I think you could think of some of the bond market programs as also market functioning aspects, corporate bonds. But then you also have in the money market liquidity paper, commercial paper, a lot of that's market functioning. But you also have this idea that that basically you're running into roadblocks, right? The financial market's getting gummed up in certain places, right? And the Federal Reserve is looking to unglue those spots, basically, or jump over a roadblock. I don't know what analogy is or metaphor is the best here to use, but really looking for places in the credit markets where credit's not flowing like we think it should, and then finding a program basically to make that credit flow. And the way they do that usually is by creating these special purpose vehicles that are allowed to buy credit that maybe investors want to feel safe buying right now. And by creating a market for them, they create, but for those assets, they create safety for that asset and make more people willing to participate in those markets.
So Tim, in my thinking, I'm going to stop that screen share for a moment. I think of some assets' inherent quality went down because of the shelter-in-place orders. Hotel bonds, less likely to be repaid. Stocks and companies that will have lower earnings and dividends, they ought to go down. But it's not just trying to support falling asset values. Talk a little bit about liquidity and the gum up, as you described it, in contrast to a value that has just gone down because of new circumstances.
Right. So the big issue here is in the short term, we can have these liquidity crises where firms can't get access to cash because, as you said, at least in the near term, prospects might look quite dismal. So hotels, a particular example, cruise lines, right? Another example, airlines in general, right? There's just no activity in these businesses right now. It doesn't mean in the long run that those businesses are not viable, right? They could be very viable and solvent 6 months from now, but they're not viable maybe in the next 3 months, right? So they can't get liquidity for the next 3 months. And that's when a liquidity crisis could become a solvency crisis, right? You basically push them out of business, make them unable to operate in the long run because they can't get access to funds in the short run. That's a bad outcome for the economy, because the more firms that get caught up in a liquidity crisis becomes a solvency crisis, basically pushing them out of business, the more difficult it is going to be to rebound the economy on the other side. So one of the goals of the Fed is to, again, make sure these credits flowing to ensure that firms that are good risks over the longer term are not cut out and forced out of business in the short term. And so it's not just about propping up the values. Notice also, if this had happened if a firm, an airline had gotten into trouble 2 years ago, or a hotel, the Fed would have said, well, this is interesting, but this is what bankruptcy lawyers deal with, right? This isn't our problem, right? The only reason the Fed is interested in this right now is because it's everybody that's hit by the same shock. And it's clearly not firm-specific issues. These are economy-wide issues, and the Fed really has a place here to try to make sure that, again, these liquidity issues do not become solvency issues.
Okay, good. Well, I think that takes us to what this means for the economic outlook, how it changes, whether we're going to have a V-shaped recovery, U-shape, or L. But before I throw that to you, I'd like to learn a little bit more about you. Can you explain why you're an economist? I mean, you're smart enough to be an accountant or a plumber. How is it that you became an economist? And then we'll get into what your view of the economic.
Well, I don't know. Sometimes I've paid plumbers, and I've wondered if I made the right career choice. How did I end up doing this? I was just inspired as an undergraduate. I had the right professors at the right time in my life, and it was something that I was interested in, and then sort of evolved in that direction. I didn't take enough math during undergraduate, and so actually after school, I spent a couple of years taking more math to get myself up to speed for a graduate program. I ended up in Washington, D.C., working for the Treasury Department, and then a private consulting firm, and then eventually found my way back here to the University of Oregon. So, I mean, that's the short version of this path of becoming an economist. But, you know, like a lot of things, there's a certain amount of serendipity involved, you know, the right place, the right time, the right teacher, and it all kind of falls together.
Well, as a fellow Oregonian, I appreciate having somebody with a national and even global reputation for watching the Federal Reserve, just 90 miles down the road from where I live, and the ability for us to get together periodically.
Yeah, no, that's. I mean, I like working in a place where there's another macroeconomist like you too. That we can in fact see each other in Salem. I'm hopefully assuming we'll see each other in Salem at some point again.
Right. So let's talk about the economic forecast. A lot of people are throwing letters out there, V-shape recovery, U-shape, L-shape, W-shape. So what's your view, and to what extent does the new Federal Reserve policy tools impact your view of the economic recovery?
So this is a very good question. There's a couple of big problems. I don't know how long this virus is going to play out, and what the outcomes are going to be as far as when we can start to reduce these stay-at-home orders. And that's obviously going to have a major impact to when the economy starts to recover. And then even after the economy starts to recover, it's most likely, or we start to reduce some of those restrictions, there'll still be restrictions in place. So, large events for whatnot. And so there's going to be some, it's just going to be impossible for activity to rebound too quickly or very quickly because of, I think, the protracted nature of this event. I think we're still looking at a lot of questions, whether this is a V-shape or square root shape. I mean, you've heard us talk about that one. The possibility that even after we recover, there'll be rolling outbreaks, that we still need to tamp down regional activity. So it should be very interesting coming out of this. To what extent is the Fed supporting this? I know for like Main Street firms and individuals, it's always hard to sort of understand, how is the Fed helping me, right? Why aren't they giving me a program specifically, right? Well, the Fed's helping you by basically making sure the financial system doesn't collapse between here and whenever we're able to start pull out of it. It's always hard to prove the negative, right? But our experience again with the Great Depression is that if you let the financial system collapse, you're going to have really worse outcomes on the other side of this. More firms will die. It'll be harder to rebound in activity. So the Fed, by doing what they're doing now, I think is setting the stage for a broader and stronger recovery when we can start to reduce these stay-at-home restrictions. Now, it's not just Fed policy too. Remember, we have some substantial fiscal policies also putting some support into the economy.
Only $2 trillion worth of.
It's some real money that, it has not been executed as well as we would like. Certainly unemployment insurance systems in many states, including Oregon, is rickety. We can't process claims at this pace, unfortunately. So the money is coming. It's slower than we would like. Same thing with the payroll protection program. The money's coming. It's slower than we would like. So unfortunately, there will be some damage that results as a result of the protracted shutdown that will reduce our capacity to rebound quickly. But there is money coming to try to smooth over the rough edges of this downturn.
Okay. Well, many of our viewers, readers, remember 2001, 19 years ago, we had a mild recession, and we had not had a recession for a decade before that one. So the biggest memory of recession in many people's minds is 2008, 2009, and it seemed to lag, even though the official ending date was middle of 2009. It felt like it was still pretty sluggish in 2010, 11, and getting into 2012. So is this a good analogy for business leaders to have in their heads, or is this going to be a different story?
Well, unfortunately, it's an issue of when we can revive the economy, and that's dependent upon the virus itself. I think if we could reliably go back to the way life was in 3 months, then I think there'd be a good possibility for that V-shape, for a fairly rapid rebound, right? It's a big hurricane, but it's just a hurricane, right? All of the conditions that existed prior to the event would still be there. Unfortunately, that's not going to be the case. That we're probably going to be stuck somewhere between what happened in a more rapid recovery and what happened in 2008, 2007, 2009, right? So one of the reasons that 2007, 2009 dragged on was that we damaged the financial system. We were actually having a fairly slow flow of credit. Obviously, the housing market was a mess, and that was impairing household balance sheets. I don't know that we have the same problems this time because we've been faster to react. I mean, the Fed has basically said, we're not going to let another Lehman Brothers happen. I mean, we're not going to let a rush on the banking system happen. The banks are fundamentally stronger. It's the only sector of the economy that's stress tested for an 8% drop in GDP, ironically. And so, I don't think we have the same kind of financial damage. What we have is the lingering impacts of the virus. Being the main impediment here. Again, so half of or maybe more of our activity can bounce back fairly quickly. I'm a firm believer that people's behavior is sticky, and people want to return to where it was 3 or 4 months ago. People will want to return to that life. The problem is they're not going to be able to, right? I mean, we're not going to be able to do concerts or sporting events or travel. Or conference, right? I think your conference season is going to be dead in this fall as well as it was in the spring and summer, right? So all of the activity related to those things is just going to be on the sidelines for another year, at least. I don't know.
Yeah.
And so that's where you're going to see that drag out of this recession. Now, there is some positives here in the near term, not positives in general, but some positive,
less negatives.
Less negatives. When we do start to unleash activity, there's going to be a bunch that comes back fairly quickly. Again, people are going to want to start returning to something of a normal lifestyle. There's also going to be some pent-up demand. You saw the retail sales reports this month. Obviously, some very sharp drops in retail activity in March, and that will continue into April and into May most likely. Eventually after 3 or 4 months of not spending, there'll be some pent-up activity. Yeah. So you get to the other side of this, and you're going to see a burst. I mean, you're going to fast drop. So you're going to see that gets you that square root kind of scenario, right? Yeah. Where you get some burst of activity on the other side as soon as we start relieving restrictions. But then it's going to drag, I think, unfortunately, because we can't get everything together as quickly as we'd like. So different reasons for a slow recovery, but a slow recovery, nonetheless.
So you mentioned a hurricane comes and goes, but of course, when you looked at what happened to New Orleans after the hurricane left, the waters went down. The city was still did not bounce back right away, right? As opposed to most of the other Florida hurricanes where there's an immediate bounce back. New Orleans has been more or less permanently affected, I think.
Yeah, so there are, so that gets you to really another question, which is, it's an economist question, is do you return to trend GDP growth or not? As you know, we have these recessions, and a lot of times we don't return to trend GDP growth. There's some kind of persistent, I don't like to say permanent, but persistent damage to the economy. That's. And
when you say trend GDP growth, it's like there's a line that we normally are on, and we go down below it. Do we get back onto that line?
Yeah. Right, and how easy it is and how quick it is to get back onto that trend, and really that depends upon how much damage is done either to the economy. And we saw that probably Katrina caused a lot of damage to that economy in New Orleans, and then led into fairly persistent impacts. We don't know how persistent the impacts are going to be here on a long run basis. Obviously, there's going to be some persistence, as we talked about, because we can't do a lot of the activities we normally did for some period of time. So that's, it's hard not to imagine you're not going to have some damage. But again, I do believe that people want to try to work around that. Nobody really likes being in their house all the time. Some people do, but people are going to want to go out. People are going to want to resume life, and firms and individuals are going to look for workarounds and ways to continue to do economic activity within the context of the virus.
Yeah. Well, let's go to the question of what should business leaders be thinking about doing. And I wanted to do this in 2 parts. One is we showed a long Federal Reserve programs and initiatives. Does a business call up the Fed and, hey, I sign up for this, or how do these programs work?
Well, a lot of times you have to work through your banker. Is where most firms are working, into these programs. So, I know a lot of small businesses that are actively trying to get their SBA lending, basically get this payroll protection program. And the issue there is, do you have a lender that's actively working with the SBA already? Do you already have a relationship with the lender? This is why I was, ironically, 3 or 4 months ago, or even I was saying, like, if you're worried about a recession, you should have a relationship with your banker now. Because you don't want to have to make that relationship after you have the recession. But that's neither here nor there at this point. So that's certainly one aspect of what you're doing, is how you're relating to the banking system, is how you're going to relate, how most people are going to end up relating to the Fed. So getting in there early. The SBA program is getting used up fairly quickly here. Congress is going to extend it and add more money to it. So if you didn't get in your first round, try again. Keep at it. So that's the typical mechanism by which most people are going to access these types of lending, is through their banking system, banker.
Okay. Do you have any other thoughts for Main Street businesses? Company executive or small business owner comes into the office in the morning, in addition to fighting whatever fires have cropped up. What would you suggest the person focus attention on?
Yeah, the things that are hard to do at this time, but you should do, is that, there's going to be opportunities out of this. Some competitor is not going to be there on the other side of this. And so hopefully it's not you, right? Competitor. There's going to be opportunities to expand operations. I mean, for a firm that is already well capitalized and still operating through this environment, might find themselves in a position to expand. I know it's hard to think about that when you're at the stage of the cycle, but really some of the most successful companies have been the ones that have been long run, thinking in the long run. So certainly that is, I think, one place to think about. The other place to think about is, do you need to revisit things like your supply chains? Is this an opportune time to, say, boy, I was too dependent upon this supplier. Maybe now, again, as the environment is changing, this is a good time to find new suppliers. So I would think about things that are involving the churn of activity right now and where you could take advantage of that churn. That's where I think you're going to find some of the most successful business decisions made. Where there's cheap assets, right? Where you can find value now. Who's doing a fire sale? Where can you take advantage of that? There's the opportunity now to make some very careful decisions about maintaining employment. You might need a labor hoard right now, even though there's short-term cost involved in that, because you don't necessarily want to retrain that employee on the other side. So those are all things that business owners should be thinking about right now.
Good. That's been, I think, a great summary of the challenges as well as the opportunities. Tim, thanks for joining this conversation, and look forward to talking to you again.
Oh, my pleasure. Thanks for having me, Bill.